Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Dive right in, take a look, see what people are sharing. If you want to follow me at finding_finance. And if you want to join our community, finding-value.com, I dive deeper into all these sectors, looking for investment opportunities, and then sharing that with the community. I'm releasing a midweek update, which is Wednesday, today. If you guys are interested, it is posted on the website. Discount coupon code is still active. So, smart real estate bets. I really do like this guy. He shares a lot of information. I think he is pretty dang good. It says, I compiled and reviewed all of the 2024 resale data released by NAR last week and tried to assimilate it over the weekend. Taking time to absorb data and observe trends in context to history and how it contrasts with popular agenda driven narratives is always very revealing. Let's go in here and take a look. Home sales were really crappy, which makes it ridiculous. Doomers tried to make them sound even worse. Overall home sales were the lowest since 1995, but were also essentially flat with 2023. And the 2023-2024 level looks like a 35-year floor with solid resistance. I call it support. So that's existing home sales from 1968 to 2024. We've come on up. We have a turn in the 1970s, coming on up another turn here around 1995. We broke out, did a retest back to that level in 2008-9, and now we come back to that level with a lot of support in that region for whatever reason you want to call it, and we've got support there, and it's holding on at this current time in terms of existing home sales. Number two, did you read any headlines proclaiming the single family rebound has begun anywhere? Because they actually increased, I'll bet fractionally, in 2024. It would be technically accurate to say that single family home sales bounced from 2023 bottom, disingenuous but true. So there's the bounce coming from 2023 that is slightly higher. 24 is slightly higher than 2023 for single family home sales. What about home prices? Nationwide, median prices made yet another all-time high in 2024. Considering that has happened every year since 1989, except for the 4 or 5 years from 2007 to 2011, a new all-time high is standard fare. Isn't it funny that doomers never talk about that? So single-family median prices continue to go up outside of this small little area that happens about once a century. That happened in the 1929-30s crash, and it happened here too. Otherwise, higher, 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 and higher for single-family median prices. The doomers are really facing um, a tough time because it doesn't happen in history. Most of the time, home prices don't go lower. They can go flat. We saw it go flat in 1990 here. It was flat in 1990, but it's very rare in history to see home prices fall any dramatic amount outside of this one period. Let's look at the last graphic again, but note the difference in how home prices moved in year three in this era versus the bubble, coming off 2 year sales slump and a year in which prices stagnated. That's not the only difference between now and then, but it is an important one. We came on up, it stagnated, and then we dropped. We came up here, we stagnated, and then we're going up again. Big difference. Big, big, big difference. A lot of the doomers, I don't know if they understand data all that well. But this guy, he looks at the data quite well. I like how he basically breaks it apart. I can tell by his comments that he's looked at a lot of these charts and he's looking for similarities and differences based off of the data and comparing it to other times in history. The doomers are all wrong because this setup is not the setup we have today. The conditions are not the same. Foreclosures, the bank lending standards. There's a whole bunch of different things. How about home inventory units and supply for months? We all know those were up in 2024. But in single family, the crux of our problem, inventory remains lower than every year before 2020, including all of 2004 and 2005. And supply remains in sellers' markets territory. With that thing. So we are way down here and lower than this is existing home inventory in units. And this is single family resale inventory 99 to 2024. You can go all the way back into the 1960s. We're lower than everything. Everything. You cannot be in a bubble and have no inventory. That does not make any sense. Now, you can have reduced sales if the affordability goes bad, but you have to see the inventory climb. We're not seeing inventory climb, at least existing. And this is single family home supply. This is a seller's market, and we're still within the seller's market area, which is 3.8 months. We're not in a balanced market even yet. Calm down for the doomers. Calm down. How about short-term quarterly trends? Not just across the country, but in all four regions. That's a solid quarter for sales growth across the board and looks like the start of a rebound in the housing market. Home sales slowed sharply, then marginally, and then quarter four, they finally grew again. So this is USA home sales up 7%. And this is where they are. The West is really growing, South, Midwest. The condo sales are down, but single family sales are up 8%. Home sales are up 7%, being driven by single family sales. This is US growth in single family home sales up from 2020 to 2023. Elevator down, the stairs are up in year over year annual sales growth. This is the rebound that people are missing. The doomers, doom and gloomers, they are missing it. Quarter four prices were up year over year everywhere except condos in the South. That 1.6% drop must be the crash in the South I read about on X. That narrative ignores single family homes, though. Annual prices up in each segment for every region. I guess the Northeast and Midwest don't have an affordability problem. So here's, again, single family prices up 5%. There's the big moves. The South is lower, and then the West. Here is the 2020. So that was quarter four 2024. This is 2024 in total. The prices are up 10% in the Northeast, 6% in the Midwest, 2% in the South, and 4.5% in the West for single family homes. Because as for demand, it's been inactive, but it's not dead. Ignore anyone who claims otherwise. People under 55 are underrepresented in home ownership by 6.5 million consumers. First-time homebuyers in 22 and 23 was at 40-year lows. Household growth, 2021 and 2024 remained near all-time highs. Now keep this in mind. If your first-time homebuyers are at 40-year lows, that means it could turn higher very easily. That's a bullish remark, not a bearish remark. Most people who don't understand investing, you buy at lows, you sell at highs. 40-year low means that we could have a lot more first-time homebuyers come in because we are coming from such low levels. So home ownership rate by age group, you can see what it is here. I'm not going to go through all these numbers here, but the deficit to average is minus 6.5 million. Deficit to minimum is minus 3.4 million. Sales of first-time home buyers in the chart here, you can see we are real low compared to history. Even if you go back even further than history, down, 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 and it's super low here in 2022, 2023. And this is sales to first-time home buyers way down. That is where we are weak, and it's due to affordability. The people exist, the people have money, it's just out of their reach in terms of affordability. It doesn't mean you'll crash the housing market, though. And that's where I think people really struggle, is they think, oh, home sales are down, the housing market's going to crash. Not if you have inventory. If you don't have the inventory to sell, and the home buyers, they're going to be paced by the affordability. And that's why all of the home builders They still look really good, but if interest rates continue higher, we could get a pullback in home builders. We could get a pullback and have overproduction in new homes where the affordability just isn't there. That is still a possibility, but that's not kind of what we're seeing in the data yet. And annual U.S. household growth is tremendously high, and this the people exist. The household growths are there. The affordability is not, and that's what's slowing the pace that these things are going through. It says now you have a balanced look at the current state of the housing market as we start 2025. If you want to learn how to lie with statistics, there are plenty of other options on X, and they are a lot more popular. Stop playing checkers, start playing chess. This guy is way better than all these other people. Yeah, Revenge Consulting, those types, they just make up crap, guys. They don't know how to read the data. They are lying, in my opinion. So that's what we've got there. We're going to come back out of this. This is some data of 2025, though. It says this week's housing data. Are we going to see national home prices decline in 2025? New data is in. The median ask price for homes in the U.S. is $421,000. That's 0.7% lower than last year at this time. Just to share this, this is the median price of homes in the market. And we'll see what trend we develop over this year. We did see that some months last year were lower, like June and July were lower. You can see that was 2022 was higher, and then 2023 and 2024 were slightly lower than 2022. But that doesn't mean that we're going to end up lower, depending on how you look at the years. So right now, it does look like home prices are more or less stagnating to some degree. Brew markets, Warren Buffett's cash pile has swelled to a record $325.2 billion. The difficult thing here is, it's the percentage of the value that they have, and it has gone up, no doubt. So is he waiting for a market crash? Does he not know where to deploy it? Is the value not in the market? And I think that's probably the case. Probably not enough value for him to start deploying the cash in the size of the companies that he can deploy the cash in. So I think he's waiting to deploy, and he needs to find value somewhere, and he just doesn't see it yet. I'm handing you this trade on a silver platter. The fertilizer index is on the verge of breaking out from its cycle bottom. Potash stocks are low-hanging fruit. I agree with that. I think they look really good. And there are ways to take advantage of that. I do cover the fertilizer sector, and we've been adding to those positions over time when we were at these bottoms here in this total area. Fertilizer does look pretty good. Did the gold to silver ratio just produce a false breakout? Prepare for an epic move in silver. Yeah, so here's potential false breakout where you eclipse kind of that resistance top, and then it does a slingshot lower, gets everybody on the wrong side of things. So silver could do a really big move here coming on up. I have some other silver charts that I posted myself. I think silver looks fantastic. If this ratio chart can move and move lower where silver starts to outperform gold, I think we could see a huge move in silver. Huge, huge, huge move. So I'm positioned for that. Price increasing while oil is perhaps going to outperform gold. We'll speak on this during my next video. So here's gold. We have that gold to silver. Posted this of gold. Gold's been ripping, guys. Gold is our measuring stick. And what is our measuring stick doing? It's breaking out and moving higher. What does that mean in the longer term? It means that gold is our pace setter, so to speak. So it's going to reprice all of the commodities higher, is what it's going to do. And this is basically telling us that we're in this big super cycle. This guy's saying, I'm still waiting on the super cycle over here. It's like we're in it. It started in 2000. This was the big move, the consolidation in between, and then the move higher. Gold is our leader. Gold is going to price all of the commodities upward. And as this moves higher, the ratios. So what happens is a market condition comes, gold's going to reprice higher, and then different market conditions come, and then commodities will be priced higher alongside gold. It'll account for these movements against each other. So the market conditions determine when these move. Gold, as it's been ripping to the upside here, is going to reprice everything up. It hasn't done that yet because we need to get into the market condition where um, money starts to rotate away from financial assets into hard assets. And gold is kind of the leader. It's telling us that that will occur. It broke out here. Um, so we came in 99, kind of broke out, did one last move down to 2002, and then we broke. This is breaking higher, and we're going to start to see everything else come with it. Fertilizers, oil, all sorts of stuff. So if you look at the ratios here, this is the gold to crude oil. When this goes down, crude oil outperforms, but we have a shoulder, a head, and a shoulder in the ratio. We've broken on the right-hand side the uptrend line where crude oil is about to outperform gold. Now we broke out, usually get a return move. We're doing that return move right now. And then whenever crude oil decides to take off, it could be the summer of this year or something. That's when we'll yank this ratio lower, I think. So I'm positioned for that as well. Oil to nat gas ratio. I was looking at this. It's got a falling wedge and it's bullish for oil. So I look at this. What we've got is we have an era where nat gas was more expensive to crude oil. That's all these low ratios. That started in the early 90s and extended and broke out in 2009. 2009, that's when shale came on and all this other stuff. We went to a very cheap level in 2011, 2012. We've been cheap for a while here. We've been riding in the cheap section. We do have a falling wedge on the right-hand side where we could break higher for spring. This is that falling wedge of crude oil outperforming nat gas potentially. We could see a break higher here. Crude oil is setting up potential outperformance against a lot of different asset classes, even in commodities. It's doing it against NASDAQ Composite, Dow Jones, platinum, silver, nat gas here, gold, everything. So we could see a big move in crude oil here over the next few months, I would say, is where we could start the move. The AI bubble is reminiscent of the dot-com bubble. Excesses warns Bridgewater founder Ray Dalio. When that NASDAQ bubble popped, we saw a slowdown in housing starts, which I think we're kind of in that. And then when it rolled over, what they did is when it started to crash, the NASDAQ bubble of 2000, they lowered interest rates. When they lowered interest rates, that's what blew up the housing market. And I think that's going to be the similar situation. And I also think that we're going to see the dollar drop. So if the dollar drops and interest rates drop, we'll see the housing market go up. And then we'll also see commodities go up. Precious metals will go up. I think gold's already front running it. The gold ripping higher is front running this exact thing that's occurring back here. It's pricing it all in now of more money printing and potentially lower rates if they were to try to save the market. Jesse Day says, it's days like this that I wish I would have held off my recent purchases of NextGen and Denison mines so I could take advantage of these prices. But then I have to remind myself that no one can time the market and the long-term fundamentals are extremely favorable for uranium. He's exactly right. I don't think you can time these market as precise and as reliable as what a lot of people think. I'm in the long-term camp. You try your best with the technicals to get you as close as you can to entry points, but I don't think anyone can time the market, at least consistently. I think there's a lot of people that get lucky. They pretend like they had some advantage over everyone else, and then they try to do it again and they can't replicate it. So a lot of people say this, oh, I wish I would have waited to buy lower prices. But I don't think you can time the market that well. We've had a lot of weird data with, a lot of stuff coming out. People always, it seems like everyone is so bearish and that a lot of people are calling for crashes. And that's generally when crashes don't occur is when everyone's calling for it. So that's what I'll say there. Gunther says, holy crap, he wasn't joking. Trump just called for Congress to abolish the income tax. This is huge. Now, if he does do that, that would be insanely good. If he can abolish the income tax, I am so for that. I'll take tariff taxes all day if he can get rid of that income tax. I would very much appreciate that. I mean, I really like that. Now, before 1913, when we had a Federal Reserve, um, before that, we didn't pay a federal income tax. That only started in 19, sometime after 1913. 1916, 19, whatever, whenever that started. Would have to go back and look. I don't know the exact date, but it occurred after the Federal Reserve was created. If he could do that, that would be insanely awesome. I would love that. Free futures, AM update, dry bulk, Capesize was flat, Panamax was down 1%, and then tankers, the big boys, VLCCs were up 4%, Suezmax was flat. Just an FYI. I have these big charts. I like the big charts. I, still like oil long term. And the super cycle, the way that I view it, we started the super cycle already. It started in 2020, was the complete bottom. We break out of the consolidation, and then we are back here at that breakout there. So I think we're going to break out and start running higher at some point. Now, if there is a slowdown in the market first, I mean, we might get a dip before that breakout. And that's what everyone's contemplating. Are we going to get this dip that we got in 2001 here? This was 9/11 and then the rip. I don't know if we have a 9/11 event. I don't know if something like that comes. I can't forecast that. But we've broken the consolidation to the upside and everything looks really good. A lot of the majors look pretty good. The Chevrons and the Exxons, they've all broken out of their consolidations to the upside. So I think those look good. And they're rhyming with what I'm saying here of this being a super cycle to the upside. Super cycle being from 2020 all the way up to wherever it peaks at. Could be 5 years from now, 5, 10 years. Silver is still looking fantastic, and I usually you see silver start to break out with gold and with a commodity bull market. This is a big cup and handle, cup and then the handle. It's broken to the upside. We're in this big super cycle. I think it started in 2000, where we get the big move and then we consolidated, and now we're breaking out again. So I think we're in that big kind of super cycle. You could say that this was the super cycle in the 70s. It started early 70s, consolidated, and then broke again. I think something similar like that is occurring right now. So that's where I get my super cycle, view. Uh, I also think that this is going to go up with interest rates and gold. If you look at history, Ali says the company faces a 7.5% budget reduction for 2025, severely limiting its ability to reverse the production decline, with only 22.75 billion allocated for 2025. Guys, this is declining no matter what. And what we're talking about is Mexico, Pemex, said on Tuesday its production of liquid hydrocarbons in December dropped 12% from a year earlier, making its lowest level all year and missing the government's target for a third month in a row. Crude condensate production averaged 1.62 million barrels per day in December, down from its November output of 1.75 million barrels per day, and below the government's target of 1.8 million barrels. Crude production hit 1.35 per day in December, down 13% and marking the lowest level in more than 40 years. You can dump more money into this, but fine. What you'd be doing is trying to slow the production decline. You can't reverse it. I don't agree with that. You're not going to reverse the production decline. Technology or new ways to extract. Um, Even then, it might be geology constrained. And this is where people don't understand. It's like drinking water out of a cup. You can put a bunch of straws in the cup, you can extract it faster, but you're not putting more oil into or water into the cup, however you're using it. So geology constrained means you can put a bunch of holes and put a bunch of straws in it, but your flow rate doesn't go up again. You're getting constrained by the geology of the deposit. And people don't understand this. It's like, well, they have all these reserves. It's like you can't flow those reserves though. It's oil dispersed amongst sand. It's real hard to get out. Versus sucking it out with a straw, so to speak, of a nice clean deposit where you can do all these things and yank it back out pretty easily. So I think that oil is going to be a problem here. We're seeing these declines occur all around the world. And I don't know where we're going to get a bunch of fresh production. The decline rate around the world, we're going to have to add about a new Saudi Arabia every single year to stay flat in oil production. This will be, or could be, one of the biggest problems that the world's going to face is a declining oil supply. And we'll have to figure out ways to work around it. I'm sure there's a lot of things that we can do from an efficiency perspective, and there will be substitutions. And I think it won't maybe be that bad in the beginning, but it could get bad depending on what the decline rates look like and what production looks like out in the future. Peter Schiff says M2 money supply grew by 85.5 billion in December. That's 0.4%, which equates to an annual inflation rate of 5%. For all of 2024, the inflation rate was 4%. My expectation is that money supply growth will pick up considerably in 2025, meaning future CPI increases will be much greater. A lot of people are saying that, I saw some people calling for deflation. I'm like, guys, I don't know about these deflation calls. They think that price movements in oil and other commodities is deflation, and it is in a consumer price index. But what's driving it are these M2 money supply growth. That is inflationary. And then when you get the growth in the M2 money supply, it filters through the system. It takes time to get through the system. That increase in money supply, it takes about 12 to 18 months to work its way through the system. And gold front runs it. So gold's going up. That's what's going to increase that ratio for all of the commodities to go higher. And then when the money finally hits the actual system and starts going through the system, that is what increases the price of all those other commodities. Oil will move first. And we came off the bottom in late 2022. You add 12 to 18 months to that, and that's starting to hit us now. And that's where you're going to see fertilizers start to go up. You'll see oil start to go up. You'll see nat gas and all these other things in the system start to go up. Josh Young says the projected doubling of U.S. LNG export capacity by 2030 is even more remarkable when you consider how much global LNG exports have already grown. And this is looking backwards. We don't, you don't really look backwards all that much. This is 2000. Look at the move on this. Maybe 130, 140, 150 here, all the way up to above 500 from 2000 to 2023. And we've got massive growth coming ahead of us all the way out to 2030. So this is looking backwards and just looking at the growth that we've had in LNG exports capacity here for natural gas. And then looking forward, it's a huge growth industry. Huge. And this is America, Australia, Asia Pacific, Middle East, Africa, and Europe. This is everything all added together. The Americas is the blue at the top here, which we had like nothing. And now we have grown substantially. And we're going to grow way big out into 2030. Robert Friedland says in economics, the Jevons Paradox occurs when technological advancements make a resource more efficient to use, thereby reducing the amount needed for a single application. However, as the cost of using the resource drops, overall demand increases, causing total resource consumption to rise. So it's just saying that as we reduce the per unit consumption of a commodity or whatever that thing is, its total demand goes up because of the affordability of the declining commodity use in the end product. So we are using less per product, but more in total, is what Jevons Paradox is. Energy headline news, hard to see more oil drilling in the US without major incentives. Oil prices would head higher, and yeah, oil prices being the incentive. Morgan Housel says, spending money to show people how much money you have is the fastest way to have less money. That's pretty true. Pretty funny. Warren Buffett says, you don't get paid for activity, just for being right. So they don't get paid for activity for just being right. A lot of people think they have to do activity. Oh, I got to change this. I got to change that. Nope, you just have to be right. And if you choose good companies in the beginning, get in there, you sit in them, and you ride them. Anas says, no way for Trump to significantly increase U.S. shale production, says the analyst. No way to increase it. Significantly, at least. Here's another one from him. He says, tariffs are mostly paid by U.S. consumers. President Trump's tariffs are taxes on U.S. consumers and subsidies to U.S. producers. They are a transfer of income from consumers to producers and the U.S. government. In practice, no study of the Trump tariffs has found any evidence that U.S. tariffs result in lower prices for U.S. importers. On the contrary, study after study have shown that U.S. tariffs levied since 2017 have instead been fully passed through to American buyers. If he does do the tariff thing and increases above, I hope he eliminates the federal income tax. If he does that, I'm all for it. If this is just another tax, I don't want that. Really don't. Global oil inventories are at their lowest levels in recorded history. Here we are declining even further. So why is the price of oil staying quite low? Good question. Is the plunge protection team in there? They need oil low because it's a subsidy to the system. It's almost like quantitative easing. Oil prices going up will also increase interest rates, and they want interest rates to go down. They are in a very difficult position because you need to lower interest rate, or you need to lower oil prices to lower interest rates, and then that's what they're pushing for, and that will push the stock market higher, the S&P and the NASDAQ, if you have lower interest rates. So interest rates, oil, and pushing that all in the same direction, I think that's probably what they're trying to do. Here's the problem, though. You're going to run out of inventory. So how are they going to manage all this? I don't know. I think oil is going to go higher. I think rates will go higher eventually, and they're going to fail to try to hold it down if they try to do that. And this is oversold levels. This is I talked about that last time. So that's where we're going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Discount coupon code. We've got the midweek update that's released. Go check it out if you like. And that's all I've got for today. So we'll catch you next time. This is Finding Value.